make money. Over to you, Melissa. Is that going? Get that mic going? Yeah, I can get you another handheld if you want. It's fine. There we go. Okay, give you that one as well.
Hi.
Can you hear me now?
How are we doing?
Better.
Just speak, it should start working, I think. Start talking?
Okay, hi. Well, is it working? Better.
That's better.
Thanks. Yeah. Well, welcome to the session, It Takes Money to Make Money. My name is Melissa Blau. I've been in the online gambling industry for 15 years now. As an operator and as an advisor, I have been also working on the financial side, helping companies raise money and making a couple of my own investments. I'm mainly now in the US, but sort of split my time between the two. And I'm going to introduce, let my panelists introduce themselves, or we're going to talk a little bit about the questions. So let us know if you can't hear anything, because I can't hear myself. So, it's louder? Okay. Would you like to introduce yourselves?
Okay.
So I'm Julian. I'm a founder and partner in RB Capital. We're an M&A brokerage and advisory. Can you hear me now?
That's better. Can I just jump in there as well? If you've seen the headphones on your chairs as well, you can hear the noise rising in the background. You put them on and hold down the button until it turns blue. So this button...
I did it yesterday and it works brilliantly.
Yeah.
It feels a little geeky, but it works brilliant because there's so much feedback.
Yeah. And you guys, you'll be able to hear everything crystal clear then, they're saying, so... Okay.
No?
They're already on. Cool.
Okay. Take it away.
So, hi, I'm Julian. I'm an investor and partner in RB Capital. It's an M&A funding and brokerage company that my partner and I started 4 years ago. Initially, we focused just on the funding side. So capital that we got from exits from previous businesses, we sink into other startups. But more recently, we've been focused a lot on M&A on the sell side, representing a lot of gambling, affiliation, and fintech companies looking to sell or to partner with larger businesses. And there's been a lot of interest over the last 18 months, a lot of M&A activity, as I'm sure Carla will be able to confirm as well. It's a very exciting time to be in this space. It's a very exciting time to be raising capital. It's a very exciting time to be making capital as well. But as with always, there's risks as well as opportunities. Yeah, it's good to meet you.
Hi, good morning, and thank you for waking up and entertaining us with your presence. I'm Carla. I've been in the affiliate space personally for the last 15 years, so I've been on the affiliate side of the world. I've been an operator side of the world. I ran the brand Betson.com, so probably a few of you know that brand. And in my recent career move, I transitioned into my role as CEO of Optimizer Invest. We're a VC. We invest in both the gaming and the non-gaming space. Particularly the notorious company that everybody here certainly knows of is Catana Media. We're responsible and we assist in all the M&A around Catana Media. So a lot of the stories and the press releases that you read about, that we've been an integral part of that. We also have a similar company to Catana Media that's growing in the affiliate space, but also in the financial services space, and that's Investo Group. And I can actually officially tell people now that yesterday Investo closed a capital raise of £7.5 million to continue actually their M&A activity in the financial services space. So lots of exciting things happening here, and thank you for having me.
No, thanks for participating. I want to just start out with a general question about what the M&A and investment environment is like right now, and you said it's a great time to be in it over the past 18 months. Maybe what's changed over the past 18 months that has made it better? But I've been writing about this sector and the lack of investment in it for 15 years because so many funds have been precluded from investing. So I'd love to hear from you guys, what is it that's changed?
It's a good question. And I think there's a number of factors, it's not just one. First of all, there's a lot of buy-side interest. So a number of big organizations, a number of big affiliate networks, a number of big VCs are looking to expand, not organically, but through acquiring and investing what essentially is in strategic capital. So assets that may be undervalued today, but will probably be of significant value 3 to 5 years' time. And it's always a really good space to be able to make investments now. So M&A happens a lot. So a lot of buy-side activity and a lot of buy-side interest happens right now. And it's been happening now for the last 2 years. But I think also there's a lot of convergence, particularly in the gaming space. There's a lot of regulation or changes in markets that actually make specific players, specific operators, specific affiliate networks to say, right, should we converge now? Should we prepare the business for an exit? Should we prepare ourselves to ensure that there's a strategic partner that we can bring on board? So I think a number of those factors, and VCs right now are underinvested, not overinvested. And that is always a risk from a VC perspective. You want to make sure you have a fund that's fulfilled, so it's completely seeded. Having a fund that's not closed is actually more of a risk than an opportunity. So the need to actually close out a fund and let it mature over 3 years is actually one of the most stressing points for a VC. So ensuring there's right assets that are ripe for sale is really important. And all those points are coming to convergence now. I don't know what you're seeing in the market, Carla.
I have to look at this from two very different perspectives. It's like one, we're a VC, we're investing in the gambling and the fintech space, but we're not a fund. So we don't have those type of commitments that you're talking about there. I think we are able to kind of have our head on our shoulders a little bit more and less pressured in terms of like quotas and, you know, type of like that. That's kind of a comfortable position to be, especially it makes my job awesome. But let's move on to the kind of M&A space within the affiliate sector, right? I mean, really and truly, I don't see anything has really blocked us or stopped us in our activity in this space in the last 6 to 12 months. And Julian, you are familiar with this. I mean, how many times a month are we meeting with prospective leads towards Katana, right? I mean, there's certainly a high level of traction in terms of acquisition, especially in the affiliate space. There are a lot of regulations and jurisdiction changes that do influence the way we look at potential assets. And I'm sure we're going to jump into that further, so I'm not going to dig too much there right now. But I think it's an exciting time, to be very honest.
I mean, right now the stock market's doing well. Companies that are public have, high stock prices, which also access to capital. Could not change in the next couple of years. Like, is the time to raise capital like now?
There's always the right time to raise capital, and you can never really call when that's going to stop. But that could change very soon. A year ago, we were looking a lot at taking Australian interests to market. Then Australian government changed everything, and all of a sudden, we are dealing with assets, not necessarily at a fire sale, but pretty close to that. So the need to restructure before a legislation or a regulation change is always needing. To raise capital with a strategic partner that knows these things is even more important, especially if you have a fund or an investor that needs to be illiquid over the next 18 months to be fully vested. Right now is an incredibly good time. And there's a number of macroeconomic factors outside of the gaming space that are actually really important. So right now, pound dollar is reasonably competitive. So anybody with US-based interests are looking to invest in the euro market or a pound market because the assets are relatively depressed, so reasonably good value. There's a lot of convergence in crypto to pound, crypto to dollar. So anyone that actually makes transactions with liquidity from crypto or to crypto transactions should have an interest now before crypto actually reaches $8,000, $10,000 per Bitcoin. That actually is a very big sentimental threshold. Once that happens, all of a sudden a lot more funds in the crypto space using affiliate payments settled in crypto will become very interesting. So the time to invest is now because of liquidity, because of market opportunities, and before any other territories decide to actually become more or less anti-competitive, which might dissuade people with funds to actually say, let's take a step back and wait for 3-4 years, if that makes sense.
It does, but I was sitting at a panel yesterday at EIG, and there were a couple of affiliates on theirs, on the acquisition side, and they were actually saying it's a great time if you're a buyer, because they felt that there was a bit of an reaction from some of the policies like Sky betting and 888, and there's a bit of an oversell on the backlash. I mean, how do you deal with those two opposing
How do you
forces?
reconcile that? So that's an interesting one. So it's a good time if you're in the selling space right now, because there's a lot of interest. But with what's happened with Sky, with Bet365, the buyers may not necessarily be that incentivized today as they were even 3 months ago. But that could change. Bet365 isn't going anywhere. They're just going to make sure they have their operations put into another territory, into another area that is more incentivized. We know Sky's doing that as well. So they aren't going away. They're just looking at better and more friendly territories to actually take advantage of. So we see this all the time, and it's actually one of those cycles. In terms of the overall perspective, taking a 2-3 year view, it's right now a seller's market because you get really good valuations for your business as long as your KPIs are in sync. So anyone doing a due diligence, a Catena, for instance, or a RakeTech, or a GIG, looking to acquire businesses right now, will look at all the KPIs, and if they are favorable, they tend to offer very competitive, very good fair market values. As we've seen, we participate in one of the largest affiliate M&As over the last few months to Catena. And Catena were incredibly reasonable in looking at all the KPIs, offering a very good settlement package for the seller. And it's a very good incentive. So having somebody with a really good asset right now, with a really good set of KPIs, with a cautious look to the future, willing to help with the buyer, is actually a really good space to sell, if that makes sense. I don't know if you agree with that.
I think optimally what Katana had. I think optimally, it's very difficult for me. We want to look at assets that can grow with us, and obviously when these regulatory situations, as you mentioned, like Australia, happen, it becomes a little bit more of a challenging conversation, because on one part of the discussion, you have an affiliate who kind of like knows that the change is happening, knows that their asset's worth something, but then you have the buyer, being Katana Hat, saying, well, this is a risk for us as well. Does that mean that we don't get into bed together? Well, sometimes that just entertains the bed a little bit more, right? So I think that we kind of like to remain open-minded in these specific situations. We obviously have a commitment to the market as well, being a stock-listed company. So that kind of regulates how we move in terms of the acquisitions we make when they are in situations like the Australia case. So that's my point on that one. The point I wanted to make a little bit about, Bet365, Sky Bet and all that. Back in the day, in my previous life, when I was an affiliate outside of the gambling space, I actually personally experienced the Google affiliate network closing down. And that was probably, can I swear? It was probably the worst fucking day of my life, because we had to take 1,200 affiliates and migrate them to 3 other networks that they had proposed you migrate those specific operators to. It happens, but it doesn't mean that your business goes to shit. It just means that you need to be a little bit more persistent and invest the time and energy that you are with your links and everything else into different channels. That's just the story. That's just a sad story behind it. I think there's a lot to benefit from these situations as well, because you do learn a lot about directing and redirection of traffic.
I absolutely agree. And in many ways, this goes back to Carla's point, having a business, an asset, which is essentially risk divested on a number of points is actually really good from an M&A perspective. So you're not just hinged on your SEO profile. You're not just hinged on a link strategy. You're not just dependent on Australia. You don't just have revenue share or incredibly biased on CPA. All those factors help you have what essentially is a risk-adjusted approach to raising capital. And an investor or a buyer will look at this specifically. It will be the first set of due diligence questions. Let me look at your risk profile. Let me look at your reward plans. Let me look at what territories you're in. Let me look at your growth rates. Let me see how everything is going on. Let me see how you've performed when Penguin or Panda have released an update. On all these, not just one, but a number of these factors all contribute not only to the valuation, but also to the amount of capital you are then able to raise with investors outside of the gambling space. Because most investors outside of gambling are really risk averse. They essentially use a specific formula, and that specific formula needs to match what they assume is the market. And if you don't have those factors right adjusted for that, they won't touch any business. And we've seen it. We've seen really good affiliate businesses not being picked up by any M&A partners outside of gambling because they cannot reconcile those KPIs. They don't understand those KPIs, and you might look like have a healthy EBITDA inside gambling, but outside of gambling, somebody applies those metrics like, no, I'm sorry. It's too much risk. I'm walking away.
I've seen that over and over again. Given the fact that there's a lot of this speculative volatility based on regulatory changes in policies of companies, and if you're giving advice to someone who's either raising capital or selling, how important does an earnout then become? I mean, is that the only way forward? Because there's such a disparity in what the seller or the affiliate or the seller is saying, here's what I think my valuation is, and then you're getting kind of hammered down for all these things that haven't happened.
So from our experience, that's a really good question. I think earnout is one of the most misunderstood criteria of an investment or an earnout or an acquisition. An earnout is a time window whereby a seller or an owner of an investment will receive capital based on criteria measured not at the beginning of the investment, but at the end of investment. So it's not a deferred payment, but it's essentially a set of payment terms that come into effect should you meet specific criteria. Now, why is that important? It's important for two reasons. It's important for the investor because it's an incentive to keep people locked in and motivated on the assets that they're either selling or partly selling to an investor. But also, from their perspective, they stand to gain significantly more if they fulfill those specific criteria. So to answer your question, absolutely. An earnout is one of, not the only, but one of the criteria to ensure that they become as most attractive as possible to any would-be investors. The other one is willingness to remain involved throughout the earnout period, whether it's in a consultative capacity, whether it's in an operational capacity, but it's also the willingness to participate in this growth program. So I'm an investor, I'm sinking in 30% of your business. I want to buy 100% through the earnout period of 2 years, hypothetically speaking for that. I will evaluate your business at X amount of multiples at the end of that period. And to do that, we need to be involved in this specific program with this specific territory, launch this specific product, be on this specific app store. And if you do all these at the end of this period, then your valuation will be significantly higher than it is now, if that makes sense. I don't know what you think about earnouts.
Well, Katana hat. We particularly move towards the earnout strategy. And my perspective is this. Currently, I mean, I think I look at several affiliates in this room. Currently, where you sit, do you believe in the capability of your business? Yes, right? So you go to a company like Katana, and then you're like, okay, buy me. I'm great, buy me. And we come up to you and say, great, we want to buy you, but we want to make sure that you're still the same you in 2 years' time, in 3 years' time, in 4 years' time. So, and the reason you're so great is partially because you know what the heck you're doing. So we need to have you work with us to ensure that we go beyond that line and continue to enhance your business opportunity that you believe and you've worked so hard towards for the last X amount of years. Case in example, we might be talking to, streamers. I mean, honest to God, I like to think that I'm digitally capable, but I have no idea what the heck Twitch is all about. I do not understand what young people see in watching, a person win a jackpot and scream and swear. I have no idea, but it's engaging and it works, right? So you would then come to a company like Katana who might not have, I'm not sure of the actual operational landscape there to the points, because I'm not sitting there in their offices, but I'm sure that you as an affiliate have a certain capability and a skill set that you can bring forward and teach us. It's a little bit like an extended resignation period. You don't just up and leave your company and then just say, oh, well, fuck you, I'm off to do my next thing. So that's the way I see earnouts in a very brutal way. But I'm gonna now put on my other hat, and I'm gonna call myself Investo Group. A totally different scenario here. Here we're talking in the financial sector. We're talking cryptocurrency-based traffic aggregated sites. And a lot of the affiliates that might not have the skill set to drive revenue in the same way that the actual owners or founders of that business know how to do. So there has been 1 or 2 cases where we have acquired the asset without an earnout. Why? Because we can see an opportunity and a skill set that we can apply to that they don't have and we don't really need. And this person just wants to sell. I've been running a pension site because I like following pensions and blogging about it every day. Okay, but do you know how to monetize that traffic? No, not really, not interested. So each scenario, it has to be looked at differently.
I don't want to belabor this point too much, but I feel like if we're on an investment panel and we don't talk about ICOs a little bit, we're kind of not doing a service to the audience. But where do you think the ICO market's going to go? Is for gaming, for affiliates, is there a market there for the affiliate side? I certainly see on the gaming side.
So we've just come out of 2 ICOs. We had an esports ICO in Australia last week. We opened it, and within a week, the numbers we saw, no traditional VC would have been able to raise in such a small space of time. The other was in the fintech space, same thing. Within 2 weeks, based on Ethereum, the amount of capital raised by individual speculators was astounding. Are ICOs here to stay? Absolutely not. They are incredibly risky. An incredibly low amount of due diligence is applied on ICOs, to the point that we're going to be in the same problem like we were with crowdfunding. So if you look at the Crowdcubes, the Seeders of this world, they were kind of a big thing 4 years ago, because I could put a PowerPoint presentation on top of a seeding platform, and within 1 week, I'd have everybody putting in money. But with all these things comes risk. I think with ICOs in general, it's a really easy way to convert your cryptocurrencies into an instrument or a token of which I do not know what the end value is going to be, if at all. It will work for some. Esports is incredibly hot. There's a very good market in the Twitch sector, in the 16 to 24 sector that is monetizable. But anyone that can think that they can tokenize an offering and bring it to market and make money for themselves as for the investors, I give it probably a 5 to 7% success rate. I don't know what you think, Carla.
Which hat to wear? I'm going to answer this one with my personal hat. I participated in my first personal ICO just a couple of weeks ago. And when I did, I thought, oh well, I could have bought a handbag instead. Really and truly, there's a lot of hype around the ICO space, and I strongly believe that this is a 3 to 6 month window that we're now riding in terms of before there's some kind of regulation or just like a big bubble when it comes around ICO. But I stand to be challenged, so if anybody has like a comment that can challenge me on this later on, I'd love to hear your opinion. The thing about ICOs is I think there's a lot of misconception about what the value is in terms of a token. It kind of disrupts entirely the idea of the typical investment and the dividend and the whole return and ROI of the landscape that what we know as venture capital.
And oversight.
Yeah, I mean, and the whole due diligence factor, I mean, what due diligence factor, honestly? You read a white paper or you read a document, you invest in the belief of the person proposing the opportunity. And then I think it's very important to see what you as a user, as a potential individual, maybe can see back from that return. And that's why I did it. I did it kind of to learn a little bit about it. I did it because I believe in this specific company, but the actual CEO of this specific, I'm not going to name company names, it is in the gambling space. He actually wrote a nice article about participating in ICOs actually on Medium. So now go search gambling ICOs, Medium CEO, and you'll find out what I invested in. There you go, some homework.
I think there's 2 takeaways about ICOs. They will make money for the right investor, but there is no due diligence being applied now, and that's a significant risk. the whole aspect of lack of due diligence risks removing all of the ICOs from the surface of investment, because anyone who's anyone can just write a white paper and just float it out there. So due diligence needs to be applied. I mean, this is now our 12th ICO we're involved in, and we've probably rejected about 50 or 60 others, because the due diligence is incredibly more than any traditional investment. So that's the first thing. And the second thing, as Carla was saying, regulation can change at any time. The moment the SEC or any other financial state deems an ICO to be some sort of exchange mechanism that has risk attached to it, they will be outlawed. And this is not China we're talking about. This is Europe. This would be the UK and the US. That becomes a big issue. And let's not even go to the potential risk of actually taking money from US investors into a non-US entity. We all know what the risks are with that. So the point about ICOs is right now they are a really good way, a really quick way to overvalue an asset, but due diligence needs to be applied. And the best one aspect I can give you is always look at what token you're buying, check the token you're buying, what is that redeemable in the real world? Because it is not, then frankly it's probably not worth investing in the first place, if that makes sense.
Can you expand on that a little bit? Because to me, like a lot of the tokens that I've seen, especially for the gambling sector, is the investment token is also the wagering token? Right.
So the whole aspect of a token is essentially a coupon. I am buying a coupon which has some form of redeemable value at some point in future to be deemed transactional by the founders of the business. Now, it can be something worthwhile. It can be some form of credit to play on an operator. It can be some form of redeemable real-life value that has a dollar value attached to it. In most cases, it's not. In most cases, it's, look, you're going to have a part of the business. We don't know what part of the business is going to be, but trust us. Give us your money, and we'll tell you at some point in time.
You do need to do your reading if you're thinking of participating in an ICO. And I think the due diligence you can do is very much down to you. I mean, you need to dig deep and really try and understand what is in it for you as an investor personally into the back office or the back dealings of that actual company.
So, and I'm done with ICOs now. Let's go back onto the advisory of raising capital. I've always said to people who've come to me for help, it takes longer than you think. And I've also said, try to think 9 months ahead at least and forge relationships as opposed to, hi, I'm here, I want some money. Because to me, I've always felt that investors want to see how you've progressed for at least 3 months. What is some of the advice that you would give to people who are out there raising capital in this room right now?
From the investor perspective, a due diligence process takes at least a month and a half. And that's assuming you get everything lined up, all the information is readily available, the networks, the sources you're going to talk to are all there, and everything checks out about you, your background, the asset, and so on and so forth. From the seller's perspective, that can take as long as 3 months, possibly more if you're going through a change process. The aspect here is you need to play the long game. An investment is not a transactional activity. I'm not going up to an investor, knocking on a door, walking away with money, and then turning up 3 years later with an earnout. It's actually a long-term relationship of commitment about investment. So, know your facts outright, start looking at what your business is valued, and there's a certain amount of process and KPIs to go through that. Start building a short list about who and what you should be approaching and with why. Why is your business important? What is defensible in your business? How can you get the necessary capital you're looking for? Shop around. There's different boutiques of VCs and investors, each of different requirements, each of different exit scenarios, and start looking to that. But don't expect to walk away with an investment in less than a month. Typically, this is a 6-month process. If you get all your cards right, it probably takes more. And if you're on a cliff edge, if you have a runway, which is less than 6 months, then you're probably too late to invest anyway, if that makes sense.
Okay, starting with the optimizer hat then. Typically, we invest in startups that are not in competition to the startups that we already have in the portfolio. So we wouldn't be technically investing in affiliate businesses because we have the assets of the likes of Katana, Gaming Innovation Group, and Investor Group right now. So just to make that very clear. But when we look at actually investing into startups, we expect paperwork to be really, really in order. And that means projections, your plans, what you expect to do with the capital. If you're on that short runway, I mean, it says something about your business as well to us. I think even when some of our own portfolio companies leave it too late to come back to us for another round, we kind of go a little bit on the defensive ourselves. Like, well, didn't you realize that your capital situation was going this way? Oh no, but we were expecting this and this to happen. I mean, you can't just assume. I mean, life can be nice making beautiful assumptions, but really and truly, that's just being a little bit crazy. We like crazy though, not too crazy. So thinking in advance, like how much money do I need to take me how far, giving yourself that extra leeway, having some padding, I guess, in your capital raise value. That's kind of good one to talk about. Julian, you can probably attest to how much paperwork and how much presentation and Excel sheets we like to see. We like to see an Excel sheet about pretty much everything. So if we were to drill down into what we would expect to see from an affiliate asset, so now I'm going to put the Katana hat on, we would want to see your revenue from different markets. We would want to see it by, oh God, I should have probably prepared a list for this. Okay, by market, by product, we'd want to see the discrepancy between your rev share versus organic versus your CPA. We would want to see all your relationships, what deal structures you have with all the operators you might be working with. Exactly, your SEO profile, your keywords. He's going to help me with this because he was on the receiving end of this request list.
Yeah, we just participated in one of the largest deals in the affiliate space with Katana a few months ago. The process probably took 3 to 6 months without getting too specific. The data required was voluminous, and rightly so.
Access to your Google account,
access to the Google accounts, link profiles, SEO, understanding how resilient you are in changes to Google algorithms, understanding how campaigns change, understanding how you are resilient to territory changes. How does your revenue plan work? Rev share versus CPA in specific territories, how do your products perform? And all these need to be specifically documented, and it's not that important if your business hasn't been going for a long while, but it does mean you need to have more documentation to be able to show how your business has performed in the short space since you've been active. All that helps contribute to your valuation.
And having it organized in a way that kind of helps. I mean, this specific deal like that you're talking about, Julian, I mean, it's worth saying that this is not just 3 to 6 months because we were touching base every month. There was daily communication going backwards and forwards here about different details and elements of the actual acquisition. Not to mention, like, just a part of it, relationships and people, meeting each other, seeing if you as an individual work well with the operational management of the actual team. I mean, ultimately, we're just talking about earnouts. I mean, if I can't stand you, then there's going to be a problem here, Like, if I'm hard-headed, which I very much am, that might be a problem if you're equally hard-headed, I mean, that's just the human nature.
Yeah. I think you're right. I think there's so much dynamics involved, either from an investment or an M&A perspective. This is at least a 6-month process. It's importantly recognizing that you need to right-size your business before you start looking at these things. Where's your tax jurisdiction? Is this amenable to any would-be buyer or investor? Because that's really important. Are you willing and able to work on a long-term with the would-be buyer? Because this is going to be a long-term relationship. And actually, can you work towards the criteria that your buyer wants you to achieve over the earnout? All these are really important. It is a long-term relationship. Let's be clear, like no other.
I had wanted to touch before on the earnout subject about some of the advice that you'd give to people in managing the period of the earnout. Like today, I had a deal that was just killed to me on the social casino space, where the acquirer didn't like the fact that the company was bringing in too much cash and they would actually have to pay the earnout out. So he just killed the deal because there was too much fixed fees coming in. So, I mean, what kind of advice would you tell people as you're two hard-headed people, or as you're earning this out? I mean, do you have to specifically outline everyone's goals on a quarterly basis? I mean, how? I've seen earnouts go wrong a lot.
Let me speak from the seller's perspective, and then I think you can give your aspect from the buyer's. You need to have the right mindset to say, this is the time for me to sell my business or to acquire new capital to grow my business. And that's a mindset change. It requires you to open up your books in a way that are attractive and appealing to any would-be buyer or investor. So that's the first thing. And that's actually probably 2 to 3 months internal work anyway. You need to make sure, and affiliates tend to be probably the worst at this case. Normally tends to be a single development stack stuck on some AWS instance in a jurisdiction that's non-tax friendly without any PCI compliance or due diligence or even GDPR writing. And that's going to be a big issue to most affiliates next year. Let's be clear about that. So that's the first thing. So you need to make sure you're right-sizing your business to become attractive, not from a KPI perspective, but from a structural perspective. The next is to actually openly be prepared to engage in an active, friendly dialogue with anyone that's interested in looking more at your business. There are gating criteria, there's confidential agreements, there's data rooms with layers of access that you can go through. So all these layers can be done. Obviously, you can go through a brokerage. I mean, this is not talking about us as a brokerage, but brokerages do help you to be able to get the right amount of value, but importantly, the long-term relationship with any would-be buyer. But importantly, it's being open, upfront, and transparent. The best and most attractive businesses to buy are the ones where the founders are keen, they're excited, they are very investable, but they are willing to work with a partner, if that makes sense.
Great. I think in this specific situation, I think it's worth saying that part of that, the 3 to 6 month process that we just spoke about is also about setting those expectations. You don't go into business without talking about, okay, these are my goals for the next 2 years. These are my KPIs. This is how much I need to spend in order to continue to generate my revenue and keep flat. This is how much a capital I need to invest to keep on going, to gain my growth. And then, I mean, nobody in the room is stupid, right? We sit around the table honestly and we say things like, okay, what is the risk assessment on this specific case, on this specific market? You have 20% of Australian traffic. Okay, there's some instability there. How could that potentially change your business or your business growth? It's not the first time that I've heard situations where you have dealt with projections, KPIs that have to be rediscussed after jurisdiction. But then it's also about who the partner you're talking with as well. So we've had a situation where we've had to re-talk KPIs and earnouts.
After the deal. Yeah. You mentioned GDPR. How has that changed? Impacted? How has the changes impacted the affiliate business? Impacted valuations?
Is everyone familiar with GDPR and what's going to happen next year? Okay, so we don't need to retread that. GDPR is going to affect every single business that essentially is a data exchanger. Whether it's data in flight or data that is at rest, you're going to be impacted by how you handle, process, and importantly, sell that data. And because we all work in the affiliate space, the way we sell and process that data is going to become under significant regulations in the EU jurisdiction. So far, it's just the EU, but it is going to regulate how data moves in and out of the EU territories. Now, what that means is that the way you handle currently your player databases, your interactions with tracking, and how you process that is all going to be under scrutiny from any would-be buyer next year. It actually should be on the way would-be buyer this year, but most buyers aren't looking at that criteria. They should be doing that next year because at the end of May, the rules come into effect. And they are retroactive, so they need to start being applied now. GDPR is as important as rev share versus CPA. It's as important as how much of my percentage traffic comes from Australia. It's as important as is Bet365 responsible for 80% of my revenues. GDPR is one of the biggest criteria next year to be from any due diligence from any would-be buyer, if that makes sense.
I know we're running short of time. Yeah, okay. So GDPR is going to, in my opinion, be most critical from the operator perspective, but that also extends itself onto the affiliates because we are generators towards that type of, to that end. I think it's worth being conscious of GDPR. If you're not collecting customer data, actual data that means the name, the address, the date of birth, the country, blah, 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 that is the type of information you're going to need to be a little bit more conscious of if you are collecting that data. It's very, very different from your cookie data, so it's worth reading into, like, how does GDPR affect me versus the cookie regulations and those type of things. So what I would advise you at this stage is just to have a little bit of a look at it. If you're not collecting core information about your customer, then you should be okay. Don't quote me on that. But it's worth reading a little bit more about just to safeguard yourselves. And if your operators come to you and just say, "Are you in a line with GDPR for next May 2018?" that you can safely, hand on heart, say, "Yeah, you know what, I'm fine."
One question. I want to just throw it out. Are there any questions from the audience? Someone? No one? Okay. I guess that's it, right?
Okay.
I mean, am I on time?
Yeah, we're right to the end of the slide. I was just giving people a few seconds. If you've got any questions for anyone, but no, that was great. Thank you very much.
Thank you very much.
Great
Great
panelists for
panels, great answers.
a great discussion. Thank you. All right.